In previous videos, we went through the 5 types of accounts. So I hope that at this point you're very comfortable with identifying what kind of an account different accounts are. Like you're comfortable with the fact that building is an asset, that accounts payable is a liability, that fees earned is a revenue. We also went through the rules of debits and credits. And hopefully you have those rules of debits and credits written down, or better yet, maybe you've got them totally memorized. The next thing we're going to go to is we're going to take both of those previous topics and we're going to use them to start to prepare journal entries. Journal entries are the first thing in the accounting process. When a transaction occurs, the first thing accountants do is record them in a journal. There are 4 basic steps to a journal entry, and as you do enough journal entries, you're going to be very comfortable with journal entries. 2 chapters from now, journal entries are going to seem simple to you. But if you don't get the journal entries process down now, you're not going to be around in 2 more chapters. So it's very important that you understand the journal entry process now. And I've devised a real simple 4-step process that is going to help you go through 1 step at a time when you're preparing a journal entry. After you do enough journal entries, you don't have to think about going through each of these 4 steps. It's going to be very simple. It's kind of like tying your shoe. When you first learn to tie your shoe, you have several different steps you go through to learn how to tie the knot. But do you think about it every morning? Do you think, okay, let's see, step 1, I got to fold my laces. No, you don't. You just do it. And journal entries will be the same way. All right, the first step, transaction occurs, okay? Transaction occurs. First step is you need to analyze the transaction and determine what accounts are affected by the transaction. With every transaction, at least 2 accounts will be affected. Could be 3, 4, 5, 6, however many, but there will be at least 2. So as you read in your book, read in a problem about a transaction, I want you to be thinking in your mind, okay, let's see, what accounts are involved here? Is it cash and accounts receivable, or is it salary expense and accounts payable? Think about what accounts are affected. All right, once you've determined what accounts are affected by that transaction, second step is I want you to pick one of those accounts and determine what type account it is. Is that an asset? Is it a liability? Is it owner's equity? Is it revenue? Or is it an expense? Okay, now that you've done step 2, let's go to the next step. Step 3. Determine if this transaction caused that account to increase or decrease. Okay, let's just say, for example, you're thinking, I know we incurred salary expense. Salary expense is an expense. And determine, did that increase or decrease? Well, as a result of that transaction, salary expense increased. We didn't have the expense before, now we do, so it increased. Then the last and final step is use the rules of debits and credits that you previously learned, or you've got them on a note card there, to determine whether you should represent this with a debit or a credit. Okay, in the little example we followed, we've said that salary expense was involved. Salary expense is an expense. Salary expense has increased. How do you represent an increase in expense? Well, look at your rules of debits and credits, and you see that we represent an increase in expense with a debit. So now we know we would debit it. What you do now is you pick out the other account that was involved in the transaction and go up to step 2 and go through the same process with that other account. And there you are. You've made your journal entry. And as long as you go through these steps, shouldn't have any problems.